Good afternoon, everyone. Thank you for bearing with us. We had some technical difficulties. I'm Justin Sugiyama. I'm the senior librarian at the Hyde Park Miriam Matthews branch of Los Angeles Public Library. While our physical library in the Hyde Park neighborhood of South LA is temporarily closed for in-person services, our virtual doors remain open, and we have free virtual programs including yoga, Tuesday evenings, and moving and groove and dance workouts on Fridays that all are welcome to attend. Without further ado, thank you for joining us for today's presentation on managing debt. This is the second in a series of 4 programs for America Saves Week. Today, Robert de Acevedo from the Alliance for Economic Inclusion will talk to you about debt management and effective debt reduction planning and strategies. Please send us your questions throughout the program, and we will have a brief Q&A after the presentation.
Great. Thank you, everyone. Again, my name is Robert de Acevedo. I work for a local financial institution, and I'm representing the Alliance for Economic Inclusion. Today, we're going to talk about managing debt. So this is something that's near and dear to my heart because it's something that I've struggled with and been able to persevere. So I'm looking forward to going over this and answering any questions that you have. So let's move on to the next slide. So we're going to jump right into it. So what is debt? Debt, the key takeaway is understanding your debt. And the first thing is so you can manage it. So let's move on to the next slide. So we're going to talk about knowing what is debt and helping you manage it. So let's move on to slide number 5. So what is debt and what's the difference between debt and credit? So we're going to talk about, because there's a lot of misinformation about the difference between both. So let's move on to the next slide. So debt isn't the same as credit. So debt is money that you owe. Credit is the ability for you to borrow money. So you use your credit to borrow money, which then becomes your debt. So debtors owe money, they borrow it. Creditors and lenders loan money. So an individual like you and me, we can only be debtors in terms of owing money. We can't be a creditor unless we loan money to somebody else. Usually creditors are banks, financial institutions, but they can also be like a car company or somebody else that is loaning you money. So let's move on to the next slide, understanding debt. So first thing you need to do is know who you owe money to, how much you owe, how much payments are, when the payments are due, what the interest rate is, and other important facts. So that was something that really helped me. When I started on this journey many years ago, we had, my family had all kinds of debt. We had student loan debt, medical debt, credit card debt, mortgage debt, car debt. I mean, you name it, we had it. So one of the first things we did to manage that is writing all of this information down, how much we owed to somebody, what the interest rate was, what the payments were, and little by little, we were able to pay off all our debt. So we became debt-free a year ago. So it was a great feeling not having any more debt. So I'm going to share some of the tips that we use to successfully get out of debt in this managing debt presentation. So let's move on to the next slide. So people get into debt for many reasons. They want to buy an asset like a house that you can pay bills, cover unexpected expenses, buy something they want. So like, for example, us, we got into debt because we wanted to buy a car, we wanted to buy a house, cover expenses. So there's lots of different things, even emergencies. So all of these areas are legitimate reasons to go into that people get into debt. So let's move on to the next slide. So how debt can affect your financial situation. So you need to use future income to pay your debt. So that's called obligating future income. So the further you get into debt, that means the more you're reaching into the future to take that income to pay off your existing debt. The great thing about being debt free now is we're actually saving more. So we're actually in the opposite side where we're saving right now to make future payments. So it's kind of the reverse, but it's a great feeling because we know that the more we save now, the better that we're going to be in the future. So one thing that, for example, that we do not want to do is get back into debt. So that's an issue into itself. And obviously, you're going to pay interest. So one of the things no one tells you when you get into debt is that it's expensive. And the reason it's expensive is because you pay interest on all that debt. The more debt you have, the more interest you pay. So not only do you owe the debt, but you also owe all the interest on top of that as well. And of course, it can impact the goals that you set for yourself. So let's move on to the next slide. So as I mentioned, understanding your debt, that's the first step to managing it. So one of the things that we tried to do to get a handle of our debt was uh, we thought we could manage it by ourselves. But what happened was without having a plan in place, our debt kept growing. And if you don't have a plan in place, it's going to be really, really hard to get out of debt. So let's move on to the next slide. So we're going to explain how debt works. So a lot of people don't understand how debt works, and I've been in the financial services industry for many, many years, and that's something you think everyone would know, especially somebody that's in it. But until you realize how things work and until you have a plan, that's when you can really start taking steps to get out of it. So let's go on to the next slide. So when you're going to tackle your debt, then you can make informed decisions. So that's the key takeaway here. So let's talk about the next slide, installment loans. So installment loans have a principal, an amount that you borrow. It also has a term. So a term is how long you have to pay, and then you pay that same amount. Whether it's a variable or an adjustable interest rate. So an example would be like a car loan. So a car loan, like our last car loan, we had it was about $38,000, and it was the same payment amount every single month, and the interest rate on that as well. So you can actually pay ahead to get out of it, and that's something that we did. Once we had a plan in place, we were able to pay it off early. So that's something that you'll eventually, once you get a grasp and a plan, you'll be able to do on yours. So let's move on to the next type of debt, which is revolving credit. So revolving credit has a credit limit, so that's the most you can borrow. And then your payment is based on how much of that you borrow. So there's a minimum payment, it's between 1 and 5% of the outstanding balance. So an example would be, for example, we have last year we made our last payment on our house, so we were able to own our house free and clear. But we also have a revolving line of credit, a home equity line of credit on our home, and it has a zero balance right now. But that's an example of revolving credit because we can borrow money on that line, and whatever we borrow on it, the payment is based on that. So that's something, as it says there, you pay more interest on it, but you can pay it off sooner if you make more payments on it. So that's the difference between installment, where you have a fixed payment, and a revolving line of credit where the payment can vary. It can be variable. So let's move on to the next slide. So prepayment. So as I mentioned, early repayment on all or part of your loans, that reduces your interest costs, and it means an earlier payoff debt. You can, there's also fees involved. So sometimes if you pay it off early, there might be some fees. So you always want to make sure that if you're planning on paying something off early, you want to make sure there's no fees involved. So that's something that we did on our mortgage. Even though we had a 30-year mortgage, once we paid off all our credit card and medical debt and car loans, we just had our mortgage. So we were able to snowball all of that, all those payments, and we were able to pay our mortgage off early. And the great thing is, and I called our mortgage company to make sure that there were no fees, there were no penalties by paying it off early. So we had a 30-year, and we were able to pay it off in 16 years. So that's something that once you have a plan in place, you're able to really get some traction going. So let's move on to the next slide. So remember, the key takeaway is consider how debt works, and you can make informed decisions. So let's move on to the next section, which is reducing debt. So the next slide. So here is where you develop your plan to reduce your debt and get help if needed. So one of the things that we did was we definitely had a plan in place, and then we looked for help wherever we could get it. So I encourage all of you, make sure that you follow these steps to develop a plan to get out of debt. So let's go to the next slide. So the first one is a high cost debt first method. So this is where you pay off your debt with the highest cost first. And then the other method is a snowball method. I mentioned that earlier. Snowball method is paying off your debt with the lowest balance. So for us, we kind of used a hybrid model. So we used both of these interchangeably. So one of the first things that we decided to tackle was my wife's student loan debt. So it didn't have the lowest balance, but it was really close to being paid off. So we made a decision to pay that first so we could free up a little cash flow on that and then use that money to pay off other ones. You want to make sure once you track everything, you'll be able to see which debt has the highest cost based on the interest. So then you can decide, do I want to go high cost first or snowball method? So let's move on to the next slide. So the advantage of a high cost debt method first is you save money. But the disadvantage is the progress may feel a little slower. So again, you pay amounts that are due on each debt, and then you can make extra payments on the first debt, and then you continue as needed. And let's move on to the next one. And then the snowball method is you make progress faster, but the disadvantage is you pay a little more every month. So I like the snowball method because once you pay off like a credit card, for example, say you have a credit card with $500 on it. Once it gets down to 400, 300, and then eventually zero, you kind of, there's a psychological effect. You feel good. And it's like, okay, for me, I'm all about checking off boxes. And I get such a sense of satisfaction from checking that off and moving on to the next item on the plan. So if you're like me, you definitely want to do the snowball method, because then you actually see that you're taking steps, and you feel a great sense of satisfaction for that. So let's move on to the next slide. So as you can see, there's also organizations, there's nonprofits that help with credit counseling. There's also USA.gov that gives you information about credit counseling, as well as tips on how to choose a credit counselor. At the end of this presentation, I'm going to give some information about America Saves. We're currently in America Saves Week, and that was an organization that helped me as well, because it gave tips on how to save more for a goal that you have, whether it's reducing debt, saving up money for a down payment on a house, saving up for a vacation, whatever goal that you have, it helps you with those things. So take advantage of all these resources that are out there, because they're there to help you. Let's move on to the next slide. All right, so choosing help carefully. Make sure that you choose carefully, because there are debt settlement companies out there, and they offer to make deals with you, with creditors. And also, you should make sure you ask about fees and the process that you go through. There's also debt consolidation loans. So that's one loan that you can pay off multiple debts. So we didn't use any of these, although they were available. So I'm going to talk a little bit more about these as we go. Next slide. So remember, the key takeaway here is to develop a plan. So everyone has to have a plan. If you don't have a plan, you're not going to go anywhere. And unfortunately, in our situation, we spent a few years, probably 2 or 3 years, not having a plan and kind of hoping month by month that our debt would go down. And actually, instead of going up a lot like it had previously, it went up slightly. So eventually we got to the point that, wow, we're not making any progress. And the reason is because we didn't have a plan. So let's move on to the next slide. So now we're going to talk about non-payment of debts and debts and collections. So the next slide. So make sure you never ignore a debt collector. Make sure that any debt that you have, that you talk that you're open with it and you communicate with your debtor. One of the things that helped me was one of my first jobs when I got out of college was working for a credit card company in their debt collection department. So I got to see how things worked from the reverse side. So let's talk about, next slide, let's talk about the life cycle of debt. So as you can see, the first decision is taking on debt. So keep in mind that it's so easy to get into debt, but it's so hard to get out of debt. So anytime that you get into debt, make sure you question it, make sure that there's no other options, because if you can save up for something rather than going into debt, it's going to be so much benefit. It's going to be beneficial to your specific situation. So make sure you pay on time and as agreed. So as you can see that once you make all your payments on that, then it becomes paid off and you're back to zero. So let's move on to the next slide. So as you can see, the life cycle of debt that's not current. So you take on debt, then you miss a payment, that means delinquency. And then you're eventually getting into default. And then one of the last steps is charged off. What that means is the credit card company, for example, they actually write off the amount that you owe because they consider it uncollectible. And then that is a negative because it goes on your credit report. So that leads us into the next slide. So if you don't pay your debts, what can happen? Well, there's late fees and there's more interest that they can charge you. There's debt collectors that will be contacting you, and you could lose services or you pay costs to reestablish them. And then if there's collateral, for example, if it's a car, the collateral is the car itself. So you could your car could be repossessed. You could lose that collateral. And let's move on. So what else can happen? As I mentioned, you could have negative entries on your credit report, and when that happens is that increases the amount of interest that you pay on future credit, on future debt, and that's the worst case scenario because it kind of snowballs. If you get into more debt, you're going to be paying more in interest. So it's kind of a and never-ending cycle that just gets worse and worse. Your credit score will drop. You could get lawsuits from creditors, and some organizations can actually garnish your wages or your accounts, and there could be even a treasury offset. So that means the IRS could actually withhold some. If you have a refund, they could withhold something to make sure that that debt is paid. So there's lots of negative consequences. Next slide. So before you make a plan, make sure that you know that you owe the debt. So keep in mind that a lot of debt collection agencies, sometimes they'll go after individuals for debt that has already been paid off or been released. So if anybody comes after you for debt, make sure that you are 100% sure that you owe it. Second, there's statute of limitations. Sometimes creditors aren't allowed to follow up on debt that has exceeded that. So you have to know all your rights, and that's where some of these nonprofits, they can help you with knowing your rights under the law. And then make sure you're dealing with a legitimate debt collector. If you pay attention to the news, you'll hear about lots and lots of cases where debt collection agencies are being sued by the federal government because of their debt collection practices that aren't they're against the law based on the Fair Credit Reporting Act. And then make sure if you owe a payment, make sure you can set up a plan and negotiate a lower balance. I've helped many individuals with that, and you may, as I mentioned, you want to make sure you keep the communication open because the debtor wants to receive a payment, even if they have to maybe cut it in half, maybe 50%. They'd much rather get something than nothing. So let's go to the next slide. So debt collectors have to follow these rules. They can't be abusive or unfair or deceptive in their practices. So as I mentioned, when I worked for credit card company, there were only certain hours of during the day that we could call, and there were only certain individuals that we could talk to. So as you can see, there's inconvenient times or places. There's no calls at work if they're told not to call you there. There's no threats of violence. There's no obscene or profane language. So we were a very large national credit card company. But a lot of these organizations are very small, so they don't really pay attention to these rules. So that's why you want to make sure that you know your rights. And then if there's any problems, you can report them. So let's move to the next slide. So remember, the key takeaway here is don't ignore a debt collector. Make sure that you pay your debt as soon as possible, and then get help when you need it. So let's move on to the next slide. So we're going to talk about student loans. So this is an exploding epidemic across America right now. So when it's time to pay back your student loans, consider all your options. And there's there's more options now than there were before. So we're going to talk about that. So next slide. So what is student loan debt? So that's money that you owe on student loans. And sometimes it's the biggest debt that some people will ever have. So, and it can become stressful. I know for us, before we bought our first house, both my wife and I, we had student loan debt, and those were the largest loans that we had at the time. So, so what can happen if you don't pay your student loans? Well, there's more fees and interest. They can actually garnish your wages or your accounts, and again, that treasury offset. So next slide. So what else can happen if you don't pay your student loans? Well, you'll be unable to get more federal student loan aid. And that was important for us because I took student loans out to get my bachelor's. And then a few years later, I decided to go back to school to get my master's. And I needed those student loans for my master's. So if I didn't pay on time for my bachelor's, I wouldn't have been able to pursue my master's degree. So sometimes you'll need to take a semester or two off. So there's negative, as I mentioned, negative entries on your credit report. Your credit score can decrease. You have a decreased ability to borrow money, and there's the stress of owing money, and there's a delay in reaching other goals. Next slide. One thing I will say is being debt-free, I mean, I feel so much more at peace. I'm definitely able to sleep better. So always keep that in mind, that your mental well-being, you're going to feel so much better being out of debt. So there's two types of student loans, private and federal. So we're not going to be discussing private student loans. We're going to be discussing federal student loans. Let's move on to the next slide. So federal student loan options, there's grace periods, there's a standard repayment plan, there's a restructured payment plan that could be based on your graduated repayment plan or extended repayment plan. So let's move on to the next slide. So there's different payment plans based on your income. So there's a pay-as-you-earn, there's a revised pay-as-you-earn plan, there's income-based repayment plans. So as you can see, there's lots of different repayment plans, and there's so many more options now than when I went to school. Let's move on to the next slide. So there's forbearance as well as deferment. So forbearance means there's a temporary postponement or reduction of payments due to financial difficulty. So a lot of students right now are in forbearance right now. They're the organization that's giving them their student loans, if they're having financial difficulty, they'll put their borrowers on forbearance. And then deferment is where you temporarily suspend your loan payments for a specific situation. So I know for me, I was in deferment when I was in school. So anytime you're in school, you can have your payments deferred until you actually graduate or you start working, because then they know that, okay, you have a paycheck and now you can start making those payments. It doesn't make any sense to have a student pay their student loans while they're still in school. So that's an example of deferment. Let's move on to the next slide. So there's loan forgiveness, cancellation, and discharge. So there's some schools that have been closed, and that student loan debt can be wiped away. There's public service loan forgiveness. So say you want to be a teacher or maybe even a medical doctor, you could have your student loans wiped away if you publicly serve in an agreed school or a hospital. There's teacher loan forgiveness, as well as permanent disability discharge and discharge due to death. And I will say too that if you haven't stayed in tune in terms of the local of national news, there's talk about having student loan debt up to a certain amount, and that's what they're debating right now, being cleared for borrowers. So if I had student loans right now, I would really pay attention to what's happening right now, because there is a chance that you could have a portion or maybe even all of your student loan debt canceled. So that's something I would keep in mind too in terms of putting my plan together. Let's move on to the next slide. So take action to prevent default. So the last thing you want is to default on your student loan. So you can talk with your, or you can talk with your the ones who's providing your student loans, and maybe you can have a different payment date that matches up with when your paycheck is received. You can have different repayment options. As I mentioned, there's forbearance or deferment. So keep in mind, this is a big one. Declaring bankruptcy does not automatically discharge federal student loans. So even if you declared bankruptcy, you can wipe off a credit card, a mortgage, auto loans, but your student loans, if they're federal student loans, those will stay with you. So that's something else that they're talking about, is maybe changing the bankruptcy rules. So again, stay tuned on that. Let's move on to the next slide. So you should beware of student loan scams. So there's lots of scams out there that you want to be aware of. Make sure you never pay any money up front. Scammers promise fast loans on forgiveness. Just because organization has a Department of Education seal doesn't mean it's legitimate. And don't share ever your ID with anyone. So always keep watch out for these organizations, because all they're trying to do is rip you off, and you always want to make sure that you know who you're dealing with. So last slide. So remember, the key takeaway here is when it's time to pay back your student loans, consider all your options, especially now with what's happening on a federal level. I mean, there's a chance that your debt could be canceled. So that's an amazing option that wasn't available for before. So make sure you have all of your options open in terms of repayment. So let's move on to the next slide, managing medical debt. So this one is something that we have experience as well. That's some of the debt that we had. It was medical debt. And if you receive a medical bill, make sure it's valid. If you can't afford to pay it, make sure you try to set up a payment plan. So what is medical debt? Let's move on to the next slide. So medical debt, it's the result of not paying medical bills when they're due. So as you can see, you receive medical care, and then you receive the bill for it, and then if you don't pay it, that becomes medical debt. So you don't start out with debt when you receive medical care. So let's move on to the next slide. So a lot of times it's unplanned. I mean, we don't know when we're going to get sick, or we are going to have to go to the hospital, and it can quickly add up. And most of the times you don't know up front. Unlike going to a store, you don't know how much procedure is going to cost, or some medical procedure. So it can be confusing, and this is one that can really add up quickly. And there's information out there in terms of insurance that sometimes can cover it, but maybe not all of it. So there's lots of details that go along with medical debt. So next slide. So there's possible actions. Make sure it's a bill and you owe it. So I remember receiving bills and calling every time that I got a bill to, first of all, understand what it was, and to make sure that I received that medical that service, and then talk about, okay, is this does insurance pay for it? If not, how much did they cover? So you always want to make sure that you understand what it is. If you don't know it, definitely dispute it. I remember disputing a few bills, and then if you can't pay it in full, try to negotiate a lower payment. Again, they're going to try to work with you, because again, the last thing they want is not to be paid. So they're going to do whatever it takes to make sure that they get paid on it. Try to settle the debt or work with a nonprofit organization. And the last option is bankruptcy. I wouldn't recommend bankruptcy, but it is an option, and you should always have that in mind. So let's move on to the next option. So medical debt and collection. So unpaid medical debts appear on your credit report 180 days after your first missed payment, and debts can still be referred to collections. And for credit scores, there's treatment of medical debt. It can vary. So I will say, from a financial institution perspective, I've seen a lot of credit reports with medical debt on there, and that's something that can, if somebody's applying for credit, it can be, that's something that if it comes up in your situation, talk with your financial institution or whoever's extending you credit to explain what happened, because a lot of times that's something that can be overlooked in terms of extending credit to you, because it does happen. And if you can explain it, and if you can show that it's being taken care of, then that's one issue that can be resolved. So for the next slide, so the key takeaway on this one is, if you receive a medical bill, make sure it's valid, and if you can't afford to pay it, try to set up a plan. So let's move on to the next topic, which is understanding high-cost debt. So high-cost debt, we want to make sure how it works, and we want to try to identify lower-cost options for the future. So let's go ahead and move to the next slide. What is high-cost debt? So this is a result of small dollar short-term loans with costly fees or high interest rates, or even both. And there's risks and benefits for all financial products and services, including high cost debt. So let's move on to the next slide. So some examples are car or vehicle title loans. So these are loans for a small amount of money for a short time, and the vehicle title is the collateral. So there's single payment loans that are often due in 30 days, and they can be very expensive. So these are something that I would avoid just because of the costs involved. But I know some people get into them. Just know that it's really hard to get out of it once you're in it, just because of all the fees, and sometimes they'll roll those over. So next slide. So this one kind of shows you how a payday or an advance loan works. So as you can see, you go through each of these steps. And as I mentioned, once you go through these steps, once you get to the step where when the loan is due, if you can't pay it back, then you may be entered into a new loan, and then they add on more fees. So it's almost like a vicious circle, that when the loan comes due, sure, they'll help you. They'll enroll you in a new loan with more fees, so it becomes harder and harder to get out of it. Let's move on to the next slide. Pawn shops. So these are items that you pawn, and usually the loan amount's 25 to 50% of how much the item is worth. And then again, you repay the loan, or you renew it, and you could lose the item. So next slide. So remember, the key takeaway is to understand how high cost debt works, and try to identify another option for lower cost debt. So if at all possible, try to stay away from these high cost debt options. So let's move on to the next slide. So this is where you kind of take ownership of things, and you take the next step. So ask yourself, what am I going to do? So how will I do it? And will I share my plans? And if so, who am I going to share it with? So you want to make sure that, as I mentioned, you have a plan in place. So for example, our plan was to put all of our debts down, and sometimes it can take some work getting bills or calling a company up on the phone and saying, what's my interest rate? How long is that interest rate good for? What's my payment? Is that payment going to stay the same, or is it going to change? So there's a lot of information to collect. So once you collect all that information, make a plan, identify which debt you're going to attack first. Sometimes it'll be the lowest amount. Sometimes it might be a higher amount, but it as I mentioned in that student loan, because it was so close to being paid off, we wanted to get it out of the way. So there's lots of things, and then do that snowball plan where you whatever you pay off first, once that's paid off, you're going to have a payment there that you were that you don't have to make anymore, and roll that into the next one and tackle that next debt, and so on. And that's what we used, and it took a long time. It took over 10 years for us to get to that point, but eventually we got to the point where our last debt was our mortgage, and our mortgage was hundreds of thousands of dollars. So that was going to take a lot of time. It wasn't going to be done in a few years. So eventually it got to the point where that debt was within sight, and eventually we made the last payment, and it was such an incredible feeling. So I want to make sure everyone knows that it can be done, and I want to let everybody know that it's well worth the effort. So let's move on to the next slide. So as I mentioned, I'm representing America Saves, the Alliance for Economic Inclusion. So this is actually America Saves Week. So this is a campaign that's managed by a nonprofit, and we seek to motivate, encourage, and support households to save money and reduce debt and build wealth. So let's move on to the next slide. So everyone can set a goal, and you can make a plan, which we just talked about, and then you can save automatically. One of the key things in making sure your plan is successful is to pay yourself first. What that means is every time a paycheck comes in, or even a tax refund, make sure that some of that is set aside for savings. So let's move on to the next slide. So what America Saves that we're trying to do is, and we use this, so it definitely works, is you make a pledge to yourself, to pledge to save. So how do you pledge? Well, you can go to lasaves.org. It's in English or Spanish, or you can even text to 877-877, and then you can sign in that way, and that's how we did it, and it's real easy. Move on to the next slide. So again, you want to save money, and LA Saves is there to help. Again, as I mentioned before, there's lots of organizations that are there to help people on this journey, and America Saves is one of those. So again, there's the text if you want to try it, and move on to the next slide. So, and this is for the LA area. So all you have to do is enter your name and choose a goal. So you can choose a goal of saving $5 a week, $100 a month. You decide the amount that's right for your budget. And again, it goes back to what your plan is. How long are you going to take? Is it going to be 12 months, 24 months? And then it'll tell you. So basically, this is a pledge between you and your pledge. So there's no one else involved. And the great thing is, once you take the pledge, you'll get reminders and tips on how you can make sure you reach your goal. Let's move on to the next slide. So there's a secondary method, which is a paper form, and you can do that as well. So there's lots of ways that you can do it. So again, these are, let's go to the last slide. So the last slide is, these are resources for savers. So there's a monthly email with tips and advice. There's a quarterly newsletter. And on the website, there's resources for saving and social media information about that as well. So I encourage you guys, take advantage of these items because it's there to help you, and it's such a hard process. For us, it was easy to get into debt, but it was so hard to get out of debt. So I know without a plan, we would have never been able to make it happen. So let's move on to the next slide. So that's it. I'm going to open it up to any comments or questions. But again, one of the things that I encourage everyone is even before you start on your process, making that plan, make sure that one of the steps that you have is actually having an emergency fund, because you want to make sure you establish an emergency fund as you begin this process to pay off debt, because you never know when you're going to encounter a unexpected car repair or something else that you need that needs immediate attention. And if you don't have an emergency fund in place, that can ruin your plan. I know from example, a few years ago, we had our refrigerator go out, and we had just bought groceries. So all of those groceries pretty much we lost, and it took a while to get a new refrigerator in place. But if you have an emergency savings in place, which we did, it makes it so much easier. So don't think that obstacles won't take place. Things happen, things break, and you want to make sure that you have the emergency fund in place. And start small if you don't have anything. Start small. Maybe save $100 first. Move up to 500, then 1,000, and then that's how you build up your emergency fund. So you're ready to go. So I'll go ahead and stop there and open it up to any questions.
Great. Thank you, Robert, for the very informative presentation on managing debt. So we're now going to open up the forum for a brief Q&A. Please post any questions you'd like to ask in the comments section. So our first question, isn't mortgage debt okay to keep since you can write off interest on your taxes, plus rates are low?
Good question. Yeah, there are good and bad forms of debt. So good debt is considered to be mortgage debt as well as student loans, because if you think about it, those are appreciating assets, right? If you have student loans, that means you're getting an education. So you're getting a degree, and that will always be with you, and it's going to open the doors to so many opportunities in terms of job prospects. Same with a mortgage. You have an asset, a house, which usually over time appreciates. So that's considered good debt. So is it okay to keep debt? From my perspective, all debt is bad. And the reason is you're taking future income and you're having to pay past debts. So you're actually borrowing from the future in order to pay off past debt. So that's why I don't want to get back into debt. If we make another purchase, we're in the process of saving right now. So we're just going to pay it off. We don't want to go into debt because you have to think about it. If you have debt, not only do you owe that debt, but you also owe all of the interest, all of the fees. So it's almost a double amount that you owe. So, and then you say, oh, you can write off interest. You can't write off interest, but again, now that we don't have any debt on our mortgage, we don't have that interest write-off, but I'd much rather have a paid off house than be able to write off a small amount of interest on this big debt that I owe. So keep that in mind. Kind of look at the big picture. Am I saving a little money here by writing off interest, or do I have this big asset that has no debt on it? So keep that in mind. Good question there. Next slide. Or I'm sorry, next question.
Okay. How much do credit counselors usually charge for their services?
Great question. There's actually nonprofit credit counselors out there. So I would encourage you to find those nonprofits, those credit counseling agencies that work free with borrowers. So anytime you're working with somebody and they say, oh, you need to pay us this, like if they want to consolidate debt, say, okay, thank you, and then call someone else. If you think about it, they're wanting to put you further into debt to help you, and that makes no sense. There's nonprofits out there that want to help you get out of debt, so there should be no cost associated with that.
Great. So these two questions, they're related to each other. What is the best strategy to decrease credit card debt, and how does transferring credit card debt on a different credit card with 0% interest for 12 to 18 months affect your credit score? And what are other considerations when making this move?
Okay, good questions there. And that was a game I played early on when I started making this journey, is moving credit balances on credit cards to 0% interest, because I'd get these offers in the mail saying 0% for 12 to 18 months, but you have to read all the fine print. They'll allow you to do that, but you have to do like a balance transfer fee. And sometimes it's just not worth it. So you have to do all the math to see if it makes sense. So how does that affect your credit score? It really doesn't affect your credit score. If you are opening up lots of credit cards, that will affect your score. But keep in mind, one of the big determinants in your credit score is how much credit availability you have. So if you open up credit cards, while that may ding you, you'll also have more availability. So it's kind of a double-edged sword. So keep that in mind. The other thing I would say is what are other considerations? Again, make sure you have a plan. So when just going back to what I was doing, I always had a plan in place, which was to get my debt down to zero. So when I was doing the transfers, it was always to make sure my balance was decreasing. If you're transferring balances and you're still making purchases, you have to know that about yourself. If you open up a credit card, are you tempted to spend? If so, don't open that credit card. If you do it and you know you're going to keep paying it down, then do it. So make sure you know how you operate, and if you're too tempted to do something, then don't do it.
Yeah, those are all very good considerations. Next question. I know you briefly went over student debts at a glance, but would there be a workshop or seminar that specifically focuses on student loan debt in depth?
There are. That's a great question. So again, there's lots of different nonprofits, especially here in Southern California, but all across the nation. And I work at a financial institution, and we constantly give workshops in partnership with our nonprofit partners on different topics. One of which is handling student loan debt. And that's such an important topic right now because there's so much going on nationally about the possibility of having student loans being canceled. So it's very fluid, it's very flexible right now. So I would look for those opportunities right now and look for those nonprofit partners to find out the latest information about that. And make sure you have that as a piece of your plan. If I was in debt right now and I had student loans, part of my plan would probably focus on other debts, maybe car loans or credit cards, and keep the student loans kind of pending right now until we see what happens nationally, because there is a chance that that student loan could be canceled. So we don't know what else is going to happen in terms of other things that you may need to do in order for it to get canceled. So I would focus on what we know for sure right now, which is the other types of debt, get those out of the way. And then the student loan, that's something that's kind of still a lot of questions that need to be answered.
Those are some very good points. Looks like we have one more question. Any tips for getting rid of student loan debt? And do you recommend getting a loan from a credit union to pay off that debt if the interest is lower?
Good question. Yeah, again, that goes to your having a plan in place. And I'm not opposed to getting another loan to pay off your student loans if the interest rate is lower. So again, it all goes back to what the interest rate is. I remember, and this was many, many years ago, but for my student loans, it got to the point where it was only a few thousand. And I remember finding a opportunity to transfer that balance to a lower interest rate, which I did because it saved me money. So that could be an option for you if you do find an interest rate that's lower. Definitely take advantage of it. Keep in mind too that when you're talking about debt, you want to know, is it secured or unsecured debt? So any credit card debt is unsecured. Whereas federal loans, those are secured. And the reason they're secured is, as I mentioned, they could actually take out money from a refund, for example. So if you can move a secured debt like that into a credit card that's unsecured, go for it. That's what I was able to do. Same thing with a car loan or even a mortgage debt. Make sure you never go the opposite way. If you have unsecured debt and you move it to secured, you're kind of just putting yourself in a worse position. So there's always a lot of considerations going on. But again, it always goes back to your plan. And take advantage of friends or family that that are accountants or lawyers or work at a financial institution. There's so many friends and family that I've had that I've counseled on their plans to get out of debt, and it's helped them. And I've been able to work with them. We've even made calls where we've called a credit card company, for example, and you can actually request a lower interest rate. They may not give it to you, but at least you can reach out and call and see what kind of offers they have. So make sure you keep all of those options open.
Okay, looks like that's it for the questions. Thank you again for the great presentation, Robert. I know I learned a lot too. So our next and final America Saves Weeks programs will be this Friday, February the 26th. Our savings at 12 p.m. and for Spanish speakers, tus ahorros at 12:30 p.m. You can learn more about these programs on our website at lapl.org. Thank you everyone for joining us. Hope you have a great day.
Thanks for having me. Bye, everyone.